Okay, may we get started with the first session of the afternoon. It's my great privilege to have a public conversation with Pat Harker. This is kind of a nostalgic time for me because we used to have lots of these virtually every Friday afternoon. One of the disadvantages of the wonderful new buildings we have at Wharton is you no longer have these kinds of meetings. I probably would never have met you, given the way we're separated now, but turns out that Pat and I lived on the same floor, and we both tended to be there late on Friday afternoons. Pat, because he's always done 3 times as much as any normal person, me because I'm very inefficient, but it was the opportunity for us to talk a lot. And it was wonderful to get to know Pat, his research agenda, and his profound interest and understanding of technology. In 1994, when I started the Wharton Financial Institution Center with a very generous grant from the Sloan Foundation, one of the in fact, the first big initiative was a study of productivity in retail banking, which Pat led. And he led a team of graduate students, many of whom got very prestigious placements and excellent PhDs out of it. And he really had results that changed industry practice. He looked at productivity in retail banking and found huge discrepancies within banks of more or less the same scale that were simply differences in their ability to implement the existing technology. Pat really began to answer the solo paradox, which is when you go into a bank, you see technology everywhere except in the bottom line. And you found some very good reasons it wasn't showing up in the bottom line. Well, Fintech is really somewhat different, but in some sense it's the same kind of issue. How does technology affect productivity in the provision of financial services? What's changed, I suppose, is it's no longer so much about the hardware as about the software. And of course, the internet, its penetration, its speed, the quality of access has made it possible to think of all kinds of things and change the speed with which they happen in a way that was simply not thought of earlier. Since Pat has this broad knowledge, I wanted to sort of organize the conversation, if we may, around 3 different areas. First, which I guess is going to be unusual in this conference agenda, but at least was interesting to me, is how the innovations around Fintech are changing and challenging the way the Fed has traditionally done business. Second would be what I guess would be the more ordinary view. How does this affect the way in which the Fed oversees the regulated banking industry, but more broadly thinks about stability in the financial services industry? And then finally, take a look at what these innovations, not just Fintech, but the broader technical innovations it represents, are going to affect long-term employment trends, and how will it affect the Fed's ability to maintain full employment, and what in fact should we be doing now to prepare for it. So with that having been said, and we will leave time at the end for questions, of course, I'd like to ask about how the Fed itself is reacting to these profound innovations in the way in which the speed with which things are done, the kinds of software, the ability to use huge quantities of data and analyze them using artificial intelligence and machine learning. The Fed has all the problems that the incumbent financial institutions have. It's got legacy systems all over the place. Plus it has, I think, even more trouble changing them because it has the obligation to stay connected with thousands of financial institutions. It has a very, very serious responsibility to maintain the security of the system and to ward against cybersecurity threats. And it has a huge coordination problem. Yet the pressures that current financial institutions are facing to do things more quickly, more accurately, are surely apparent inside the Fed as well. The Fed, in some sense, is the granddaddy of all people who sit on top of big, big data, which presumably could improve the way you facilitate transactions. It could enhance bank supervision. It could improve economic forecasting to some extent, and I'm sure there are other applications. How's the Fed thinking about these challenges?
So I'll start with the standard Fed disclaimer. I'm not the Fed. So I can only say what I think and not anybody else in the Federal Reserve System. So just a little bit of, and thanks, Dick, for agreeing to be here. A little bit of just leveling the ground. People think of us obviously as a monetary policy engine for the country and policymakers, but we're also a bank. And people often forget that the Federal Reserve System, the 12 reserve banks make up the bank. And the banking products. And we have the wholesale product office in New York, the retail product office in headquartered in Atlanta, cash headquartered in San Francisco. And so who are our customers? Well, they're banks and the US government. We're the fiscal agent for the US government. So out of St. Louis and Kansas City, lots of activity related to the treasury services that we provide. And this gets sprinkled all across the system, the kind of activity. So for example, we just build a very large and complex post-payment processing system for the US Treasury. We built it here, we handed it over to Kansas City to run and put it in operation. So as a bank, as Dick said, we have lots of legacy systems. Fedwire Security, ACH, and we can go down the list. And so we have the same problem large banks have of how to modernize those systems. But we also have another issue. So it's not just the question of how much money do we spend to modernize this. By the way, everybody thought for years and years cash is going away. We still all have cash operations. It has not gone away. Below our feet is a lot of cash, and that's not going away anytime soon. At least doesn't seem like that. So, but in addition to the legacy kind of systems that we have two other constraints that are imposed on us that Dick alluded to. One is we can't cherry pick, right? We can't pick our customers and say, we like you better than you, right? And you're profitable, you're not profitable. We have to be, ubiquity is clearly important in the Federal Reserve System. Then the second constraint that's on us with the Monetary Policy Act is that we shouldn't be in businesses where the private sector can provide that efficiently and effectively. So that raises a set of questions that we're frankly still debating. So several years ago, actually before I got here in 2015, the system launched this conversation about faster payments and more secure payments. And that process, many of you I think I see some heads nodding, have been involved in that in some way, shape, or form. That conversation continues. But it comes down to, I think, a fundamental discussion that the system, ultimately the Board of Governors, has to make a decision on. What businesses are we in? And if we're not going to be in it, can the private sector provide it? And if the private sector provides it, are they going to make sure that the small community bank in Altoona, PA can plug in? And so I think that's the real challenge for the Fed as we think through the emerging landscape of technology and changes in technology, is how do we provide the basic rails of the financial system so that the money can move efficiently? And do that in a way that everybody can have access to it. So I think that's really the challenge. And so this conversation's going on. We have not come to any conclusion. There was a Federal Register notice recently about asking questions around real-time gross settlement systems or real-time systems that other central banks in the world have put in place. Whether we do that or not is still an open debate. There's no conclusion on that.
You mentioned the other central banks in the world, and it is true, you've got to worry not only about what's going on here, and especially in this Federal Reserve District, given where we sit, but the fact that the dollar is the main reserve currency for the world, and you have to somehow interact with lots of other central banks, some of which are actually experimenting with issuing their own digital currencies. And I'm sure this is something that your R&D function has to worry about, as well as cryptocurrencies, which I assume you're not really thinking about adopting, but have to worry about nonetheless. What is the thinking about digital currencies?
So I'll start with, we've had digital currency since the computer, right? Since the advent, there's only $1.5-ish trillion of currency outstanding, hard currency in the world today. The vast majority of money moving around the system is in digital form. So I think you have to ask, so digital has been in existence since the first mainframes. It's going to continue to be in existence. That's how we move money across the economy. The question about cryptocurrencies, again, is still an active discussion about what are the pros and cons, the advantages, the disadvantages of different types of technology. I think what we're finding, and in the case of currency, we can talk about and we can argue about different technology platforms, blockchain and variants of blockchain and so forth. To me, though, it comes down to a very fundamental question. Do you trust that currency? Right? The vast majority of Americans and people in the world are walking around with dollars in their pockets, not even thinking about whether they trust that it's actually worth a buck. Right? They just walk around and assume it's a buck. Why? Because their life experience and generations of life experience have been that it's worth a buck. When they walk in the store, it's worth $1. That's not necessarily the case for some of the emerging cryptocurrencies. And there, they do seem to behave a little more commodity-like with variable prices than, say, the buck. So trust is really at the center. We only believe that piece of paper is worth something because there's a central bank that backs it up, and the American people believe that we will actually back it up. If you don't have that, it's hard to build a broad-based use of some other currency. Now, I don't dismiss the fact that people could build that trust over time, right? There's no question people could build that trust over time. But that's ultimately when it comes down to. If people don't believe it's worth what you say it's worth, it's not worth what you say it's worth.
Goes back to the fundamental principle that at root, all finance is a confidence game, in the best sense of the word, of course. But the attempts by some central banks to introduce digital currency, though, I think go a little further than you would suggest.
Yeah.
They really, and it actually speaks to the notion that we're sitting on a lot of actual cash. I think some countries actually have the ambition, and Sweden, I think, has gone a long way toward displacing
Absolutely.
with digital currency.
Yeah, so here's my litmus test. When we get rid of the penny, we can talk about digital currency.
You got me there.
We can't even agree on getting rid of the penny. That costs more than a penny to make. So I don't think we as a society are there. And it is a societal choice. So I think we're not there yet. I think the American public still likes having cash.
Okay. Let me move then to perhaps some more conventional thinking about the Fed's view of fintech, which is how are you coping with a system that is getting permeated by fintech? Not just the freestanding fintech firms, but partnerships between fintech firms and existing banks, and fintech divisions within banks, which are happening all along. They're relying on all kinds of technology that is very, very difficult for an outsider to understand. Yet you're still obliged to think about fair lending practices and a whole range of laws that pertain to basically transparency in data and decision making.
So first, we need to build our expertise. And so the kind of work that Jalapa and her colleagues are doing here, the kind of conferences, is something that we need to do not just in Philadelphia, but of course across the system. But it's beyond just assembling all of you so we can learn from you. And that's really what this is about, us learning from you and having this dialogue. We also need to start investing in different types of talent within the system. So I can say for Philadelphia, we're on a path of investing in a small but potentially over time growing group of machine learning folks. We hired our first individual this summer, and we're in the market to look for a second person. And that will be a resource for many across the bank to start to think about machine learning. And so one area is just simply understanding what it all is, right? And what it is and and most importantly, what it isn't, right? Second, as in our supervisory role, we're increasingly going to be asked to opine in some way, shape, or form, right, on the relationships the institutions have, banking institutions have, with other vendors or their own internal team on what these algorithms are. We're also going to have to figure out some very deep questions about issues around consumer compliance, fair lending, for example. And this was brought up by Governor Brainerd earlier this morning. You throw a bunch of data in, and it discriminates against women in hiring. Who knew, right? And so, and I think the institutions can rightly say, we never meant to do that. right? It just trained on that data in a way that we didn't understand, right? And that's an honest answer. So one of the things we're doing, in addition to hiring some internal resources, we've also partnered with our colleagues at Penn Computer Science. Typically, Feds always partner with local economic departments and business schools. Here, we wanted to reach out to the computer science department. There's a fellow there, Michael Kearns, an old colleague of mine from when I was on the faculty there in engineering. And we hosted a conference about a year and a half ago, half macroeconomists and half machine learning people, and really trying to understand what that intersection is. And there are some deep issues there. For example, one of the issues that Kearns is working on is, how do you build fairness into a machine learning algorithm? It's irrelevant. It doesn't know the concepts of fairness, right? And it's actually a deep technical issue of how to do that. Again, we're not going to solve that problem. Hopefully Kearns and his colleagues will. But we need to understand it, because on the flip side, we're asking banks, are you complying with these laws? And if they say, well, I don't know, the algorithm's just telling me so, that's not a good answer. You know it's not a good answer, but we need to understand it together. And last but not least, we, in our supervisory function, have lots of data that we analyze for patterns, both at microprudential levels and at macroprudential levels. And so, for example, in Philadelphia, we are the repository of all consumer loans in the system. And so we have something called the Consumer Finance Institute here, and a big part of that Consumer Finance Institute that really grew out of the payment card center here many years ago, out of the credit card industry, is a large group within supervision, regulation, and credit focused on trying to look for patterns within an institution and across auto lending, home equity lending, you name it. That is a pattern recognition problem, right? What are we seeing? What are those patterns? We have great statistical minds here and econometric minds doing that work, but can we enhance it some way with some of the advances in machine learning? I don't know the answer to that, but that's part of what the Fed does and should do, is try to work with the academic community and the industry to enhance the frontier of knowledge in these areas. So that's what we're working on.
I guess another aspect of your responsibility is to think about how to integrate these innovations and fintech firms into a system that will be more efficient, still fair and transparent, and one that has a measure of competitive equality. I guess that raises the question of whether there should be a special fintech charter, whether we should have a sandbox to experiment with this sort of thing. In many ways, we seem to be behind the rest of the world in thinking about how to deal with this set of new players.
So again, I'll reiterate, I'm not the Fed, it's just me saying this.
Yeah.
I am very sympathetic to the idea, as companies, many in this room, scale and get to scale, the idea that you have to have 50 as opposed to one, as was said this morning, probably makes less and less sense. So I think there is clearly an advantage to having a national solution at a certain level, right? I wouldn't say it's from day one for an institution as they're starting up, but at some level, having that national charter or whatever, and that is out there. I think I'm sympathetic to that. I'm not. We can quibble over the details of that, and I think there's a lot of quibbling we could do. But I think the concept, at least, it makes sense. But the other thing that's very clear is that this will continue to be a partnership between traditional banking institutions and startups. Not for everyone, but for a lot of institutions, to be that third-party vendor, that white label institution behind the scenes. And I think, again, they're like all third-party vendors, particularly for small community banks. I mean, one of the great advantages of this country that we often don't see as an advantage is we do have a great diversity in the types of banks we have. For example, I was just talking at lunch, coming out of the recession, one of the first de novo banks, probably the first de novo bank in the country, is here in this district, the Bank of Birmingham, Pennsylvania. They know how to serve the Amish and Mennonite community, who have very unique needs when it comes to their banking practices. For example, the Amish don't have insurance on the barn because if the barn burns down, the community rebuilds the barn. And so there's little things like that, but they're not so little.
Alternative data is crucial, I would assume.
So you need to understand that, right? So they're always going to, and so the third-party vendors, the core processors, are going to be critical in this effort. And they were it's not just the bank itself, but they will have to work on integrating the advances in fintech. And you know this, that's who the Jack Henrys of the world and so forth are the ones that are going to be critical players. And we need to understand more and more what they're doing and how to regulate them as well, because they're playing such a large role, just because you can get that economy of scale in the back office. And you can have the storefront serving that Amish community very well, but not having to worry so much about all the back end stuff, right? You can take care of a lot of that with a core processor and or a banker's bank, right?
Yeah, I think there are many people who have an optimistic view of what that will do to bank structure, because it really takes some of the huge advantage out of scale. Yeah. If you can make scale a utility that is available to a lot of different banks, you don't really have to be that big on your own. There are some people, though, who worry that the whole fintech advances are reducing the charter value of banks, so that it's less and less clear that banks will be able to continue as a strong and vibrant part of the financial services industry. I think that's a little hard to justify given current data on bank profitability, but nonetheless, it is an abiding concern, because you do have people providing services that are very parallel to existing bank services, but under a very different set of compliance costs and regulatory prohibitions. At what point do you need to rethink what it means to be a bank?
Well, let me add, I think that on the fintech side, on the small business and consumer side, you're right. There's other pressure on banks too, with shadow banking, right? And funding, being a funding source for commercial activity. And so you're seeing on both sides, the banks are being squeezed. That said, I still think that there is a role, there's clearly a role for regulation in the system. We need to make sure that the system remains safe and sound. It's sort of what we were chartered to do after many chaotic moments in American history.
For that.
Right, that are right down the street after the First and Second Bank and so forth. So how that regulatory structure evolves over time is yet to be determined. I mean, that's not to be determined, but it's clear that as some of these players get scale and they become what you'd have to call a financial utility, they would, in some way, shape, or form, in my mind, have to fall under some kind of regulatory structure.
Interesting. Okay, let me now turn to, I guess, the longer term issue, which is that many of these innovations are certainly sold under the principle that they're really relieving workers of routine, dull, mind-numbing chores, and freeing up workers to think about more important, more engaging problems. The issue, of course, is that the people who are being freed up from these routine chores are often not well equipped to take on the more challenging, more interesting problems. And that could, to some people's way of thinking, create longer-term unemployment issues, which will have to become a concern of the Fed over the long haul. And I know that you and several other people have been thinking about that, because there are lots of things we probably should be doing today to make that transition easier.
Yeah, so the bottom line is the machines are coming. I don't agree with my old student Elon Musk that they're all gonna, the human race is a threat right now. But there's clearly change underway, and the pace of change is accelerating. I think everybody in this room knows that, right? We've always had new technology, we've always had Luddites, we've always had the need to retrain, to get the new skills. This has been true since the Iron Age and the Stone Age, right? But now the pace is just accelerating. So we actually, in Philadelphia, we just released a report where we asked the following question within this district as an example of what could be happening nationally. So we asked, what are the jobs by geography within the 3rd district, by city, because cities matter here, because it's not a one-size-fits-all, that have a 95% or better chance of being automated in the next foreseeable future. And that number is about 1 in 5 within the 3rd district. It's a big number. And so the point of that exercise, and it'll vary a lot. You go to Reading, PA. Reading, PA, 22% of the Reading's workforce is in manufacturing. They never lost their small to mid-sized manufacturing base, and they're actually good at it. The answer for Reading is going to be different than the answer for Philadelphia or the answer for Wilmington, Delaware, or you name it. And so if there's a message in that report, it's look at the data, understand what your challenges are, And then we need to rethink, and this is an issue that we've been working on here in Philadelphia and the system's been working on. We need to stop thinking of workforce training and development programs as a social good and a government program and start thinking of them as an investment. If there's one thing we're hearing loud and clear is a skills mismatch within the workforce and people can't find workers. The growth is being limited by their ability to find the labor they need. And so what we've done a lot of work in this area, but I don't see this as a threat where Skynet's going to be active and we're all going to go away. But rather, this is a chance. It's not going to happen overnight, right? I mean, companies are going to make decisions on their capital expenditure in these technologies. Some of them are already doing it because they can't find the workers, so they've decided, well, the cost to me, the bar is now much lower because I can't find the workers anyway. But we need to rethink the model of workforce development. And so we've released a system-wide book, actually just last week in New York, we released this book. I wouldn't encourage you to read it overnight. It's 1,500 pages, 3 volumes of really interesting papers on a conference we held in Austin. But we took that one step further. We said, well, okay, so what would such a thing look like? And we've announced here in Philadelphia, in partnership with Philadelphia Works, which is the local government training program, a very large technology employer in the city, a very different model, and a nonprofit called Social Finance. Social Finance will seed with some other money the startup of this skills-based training program that are developing skills specifically for that employer. One of the problems in these workforce training programs and why they fail, I love this phrase, they're based on the train and pray model. We think we know what they want. We'll train you for something we think we know, and then we'll just pray you get a job. As opposed to employers being engaged from the get-go in developing the skill base. And so this will, the seed money will come, but then as the employers get the workers they need, they will reimburse, in this case Philadelphia Works, for that benefit of getting that worker with that skill set they need. And then this will start to create what we hope is a virtuous cycle. It's that model, whether it fits here in Philadelphia, in this case it's digital skills that are necessary for this employer, but it'll vary a lot by city, it'll vary a lot by company you work with, whatever that skill set is. But the point is, let's stop thinking of this as some social good, and it is, but start thinking about it as a real hardcore business investment that we need to make a public-private partnership to move the needle. Because this is, if I look at the state of the economy today, the biggest challenge we face right now is the lack of workers. I'm hearing this everywhere. And it's the workers with the right skill set. And you see this in the JOLTS data, the job openings and labor turnover data. I mean, we have now been running now for several months where openings are higher by a lot than the people who are unemployed. And there's this lack of dynamism in whether people don't have the skills or they're in the wrong place geographically and unwilling to move. There are lots of potential reasons, but it is one of the limiting growth factors in the growth of the U.S. economy. We need to bring more people off the sidelines into the workforce.
So it's not only a productivity measure, but also a full employment measure. It's often said, I guess, that we're much better at providing credentials than skills, and that at least it goes some direction toward addressing the gap. The Germans seem to have gone even further. Do we have a full understanding of why the German system of apprenticeships doesn't seem to take hold in the U.S.?
Yes. I think, well, again, my own view.
Yeah.
And it's going to be an odd thing for a lifelong academic, former university president to say. We are sending too many kids right away to a 4-year college. Yeah. And frankly, given the demographic shift of the college-age population in decline, I actually think it's going to get worse. There are many good, what we call opportunity occupations, and we've done this work with our colleagues in Cleveland and Atlanta. Jobs that pay above median wage where there's a future where you don't need a 4-year college degree. You almost always need something beyond high school, whether it's an associate's degree, and at some point you may go back and get that 4-year degree as you move up and you become a supervisor. But the idea that everybody in America, the path is high school then college, it doesn't fit everyone. And what we're finding is these severe shortages with machinists Ask your local people that in your neighborhoods or in your communities. Diesel mechanics. There's a guy up in Lehigh Valley that's paying starting diesel mechanics over $100,000 a year. Can't find them. These are good paying careers. And again, it could be a career that it goes somewhere else over time. But the idea, and Germans have embraced that culturally. I think it's a cultural issue, much more than we have. We sent the message out, everybody goes to college, everybody goes to college, everybody goes to college. And when we've dug deeper on this, and I've dug deeper on this, some of it comes down to the incentives we set up for guidance counselors in high school. Right? What's the measure of success of a guidance counselor? How many kids go to college?
Yeah.
Right? That's it. It's not how many kids got a great career as an electrician. Right? It's just not what they measure. And so some of it comes down to even how we, just generally how we think about what are good, solid career paths for people in our society.
Interesting. Well, I would be happy to go on, but that's not fair because we did say that we would invite a larger group of people into the conversation. So this is perhaps a good time to ask if there are questions you'd like to pose to Pat. And I think there are people floating around with microphones. Yes, please.
Right up front here.
You don't want it, if you don't, you can stand up and talk loudly if you like. It's not a very big room.
Sure. Aaron Klein, Brookings Institution. The Bank of England put a real-time payment system out when the original iPhone came out more than a decade ago. I just got a 10XR, and if I deposited a check on Saturday, maybe it's there on Thursday. Monday was a holiday. FedWire works 9 to 5, 5 days a week. Mexico, Poland, South Africa all have real-time payment systems. Why isn't the Fed doing this?
Again, this is part of this conversation about faster and more secure payments. I do think there's some things that we can do. My own view is extending the hours of, say, a net settlement system. The question for us is whether we put together a real-time gross settlement system or the private sector does. But one of the big differences between, say, the UK and us is just the sheer number of banks, right? And so in the sense of our community banking system, one of the biggest concerns they have is that they would be shut out of a purely private sector system. I mean, they've expressed this very loud and clear through this process. So what we need to do as the Fed is make sure that whatever we do has that ubiquity built in from the get-go. That said, I am very sympathetic to the idea somebody needs to do something, whether it's us or the private sector. But remember, there already are movements in the private sector to do some of this, if not all of it. So this is where we have to be thoughtful and cautious, because our mandate from Congress is that if the private sector can do it, we have to ask the question of why are we doing it? It's a little different model, governance-wise, than some of these other countries. And so we have to justify that we have to be engaged and that the private sector just couldn't do it all on their own. It's just a different set of steps that we have to go through.
But nothing happens quickly.
Yeah, and this has been a long process.
And that's
this
by
discussion's
design.
I admit, this discussion's been a very long process. I think we're moved fairly quickly on the faster side. There's still a lot of conversation around security and that task force that is being run by Esther George. Well, the whole process is being run by my colleague Esther George in Kansas City.
Okay, next question, please. Oh, well.
Stun them.
Yeah, I think you've exhausted the field. Well, this has really been very interesting. Your mention of Elon Musk reminded me of another Elon Musk anecdote. He was my student too at the time. He had a summer job as an assistant to a large Canadian bank that shall remain unnamed. And his task was to help them understand how to use the new technology. And he came away from it convinced that big banks were so encumbered by legacy systems and by sort of narrow functional thinking that they'd never be able to do it. And that's part of what led him to his, I guess, his second startup, right. Which actually had the odd name X.com until he realized he was getting a different kind of customer. And eventually it became PayPal. But it is, I think, an example of the difference in dynamics. By its very nature, what happens in the banking system is supposed to be slow and bureaucratic. It puts a very high premium on being absolutely accurate and reliable. But that's not the way technology works, especially in the modern world. And so it's a very difficult position to be in, especially if you have to be referee of the system, as the Fed more or less does.
Well, many years ago, I had this undergraduate at Wharton explain the world to me, which Wharton undergraduates tend to
Often
do.
Yes,
do that a lot.
It's not hard to find.
He said, look, the world's really simple. There are big organizations that have scale and scope, but they can't innovate themselves. They can't innovate their way out of a wet paper bag. I don't want to be in there. I want to be the small startup that sells the technology they can't develop to them, stay there for a little while, and then get the heck out and go back and do one again and recycle. That's kind of true, right? I mean, those days of innovation within a firm, and forget banking for a minute. Forget banking for a minute. You just look at some of the greatest innovative engines in American society. I used to be visiting something or other scholar at Bell Labs in Homedale. This was the greatest R&D facility in the world. Yeah. I mean, you walk down the hall and there are Nobel laureates. It's now being turned into an office complex, senior citizen living, and and it's gone. Now, part of that is they were a regulated monopoly and they were able to do this, right? So you understand the economics.
But we haven't really replaced that function.
No, and so what we have replaced that function. We've replaced the function with the market, right? And so, and also with the Bayh-Dole Act, which people don't quite give full credit to. Before the Bayh-Dole Act, universities, if it was government-funded research, had to publicly disclose everything. You don't have to do that anymore. You can hold the patents. The universities couldn't hold the patents. Now universities have an incentive to commercialize this, working with startups, either from faculty or with venture capitalists or angel investors, and that changed the whole ecosystem of innovation in America. I mean, now the vast majority of stuff, the truly innovative stuff, at sort of base level. I'm not talking about, a particular application on the phone, but sort of base level research, like, for example, quantum computing. A lot of that is growing out of university research labs. I mean, and that's been true of material science and chemical engineering and you name it. And so that is the ecosystem we have today. So it's no surprise that banks don't have big R&D. I mean, think about Citi in the day, right? They're spending all this money on innovating on ATM machines and other technologies. And, well, it's not only Citi's not doing that anymore. No large corporations, by and large, do that anymore. It's just not the system we have in America today, and really in the world today. It's just a very different innovation ecosystem today.
Well, this has been a very far-ranging conversation. Please join me in thanking Pat for giving us some of this.